Hello everyone, welcome back to the Velocity channel where this is your bridge to financial freedom. Now today we're going to go ahead and make sure that we take care of, that means eliminate, $88,000. It doesn't matter if this is part of your mortgage, your student loan, your car loan, doesn't matter what loan it is. We are going to eliminate it very quickly with a little amount of money. And oh, by the way, we're going to be doing something fairly new here, but it's going to be something that we have not incorporated with this strategy. I want you to take care to listen to every bit because this is going to make sure that you're out of the debt very quickly. Now, before we get into that, like, share, and subscribe so that everyone around the world can know the power of Velocity Banking. Are you ready to get out of this $88,000 debt very quickly? All right, let's do it. So let's, like we always do, make sure that we know what's going on. We've got the debt of $88,000, so that's going to be a loan. And as was stated earlier, it doesn't matter if this is your mortgage, your car loan, your student loan. The point is, it's an $88,000 loan at 10%. What does that mean? That means there's going to be a minimum monthly payment of around $1,162. Now, yours may vary slightly, but whenever you have a scenario like this and that loan is most likely amortized, this is going to be the minimum monthly payment. Now, remember, this minimum monthly payment does not go towards the principal. Only part of it goes towards the principal. And that is the part that the bank dictates what you should give them. You see, that's why we want to get out of that, man. Aren't we tired of the so-called authorities, whether it's doctors, whether it's lawyers, whether it's bankers, telling us what to do and we getting the short end of the stick, meaning it's not benefiting us. Let's go ahead and do something that benefits us. But before we get that far, we want you to know what they're doing to you so you know how to get out of it. Now, when you have this minimum monthly payment of $1,162, we have both an interest and a principal payment. The interest payment is signified by that number right there, right? The interest rate. And so on the first month, $733 is going towards, I got to give you a hint. It's not you. Going towards the bank, and $429 is going towards the principal payment. Now, let's go ahead and jump ahead to the 12th month here. What is it going to be on the 12th month? $692 on the 12th month, okay, going towards the bank, and then $470 goes towards the principal. Now, do you see how much you've increased on the principal side, right? That's going to be very important because we're going to make sure you know of a strategy that if you aren't comfortable deploying $500, it's going to make a huge difference on the strategy that I'm going to bring up next, okay? So let's go ahead and jump ahead to the 24th month, which is going to be $643 towards the interest. Then we got $519. Do you see how it's going up? It's because you are continuing to pay, and as you chip away this principal, what are you doing to the interest? That's right, you're chipping away the interest as well. Why is that? Well, because the interest is the parasite and the principal is the host, okay? The smaller the principal, the smaller the parasite. Then we're going to go ahead and jump to 36 months. And you know what? We even have a 48 month here because I want to share with you some things that I didn't in the other videos, okay? $588 goes towards interest, getting smaller, right? And then $574 goes towards the principal. And then on the 48th month, $528 goes towards interest. And then $634 goes towards the principal. Now, that's how your money's getting divided up. And over 4 years, look how much you were able to diminish. Now, you have diminished. the interest. Okay, you have. But are you okay with these results? I want you to look at them because these are the results that normal people have every day. They're content with paying the minimum monthly payment month in and month out. And as the bank continues to make their money off of our ignorance, they don't know that there is a better way. Now, I told you that I was going to share with you what happens when we do the $500. But some of you are like, listen, CJ, I've got the $500 extra, but I work so hard, I don't want to spend the $500 extra. I don't want to be out that money. How can I still allocate my money so that I'm quickly taking care of this? By the way, this is 10 years. Taking care of this 10-year loan, right? How can I take care of that in the best way possible? And so what I did was I said, okay, well, you don't feel comfortable with the $500 being deployed every month. Fine. You don't have to. This is what I did. I said, well, you have a line of credit that perhaps you haven't touched. Maybe it's a home equity line of credit, whether it's a second lien or a first lien. Listen, you really should get a all-in-one HELOC, a first lien HELOC, because that's going to replace your mortgage, but I digress. But they're saying that they want another way. And so I gave them another way. I said, well, you have a line of credit that has not been used of $10,000. Okay, this is a line now. Okay, don't worry. We're going to be using our lines to get rid of our loans. Okay, that's the way it is. At 21%, let's say. Okay, hasn't been used, but you need to use it because you want to get out of this debt in less than 10 years, and we're going to do it. May I suggest, since you have some cash flow, let's say the cash flow is $500, may I suggest deploying that line of credit towards this number right here? What is that going to do? That's going to take away a chunk of that principal. And what is it also going to do to the interest? Remember, the interest is what's killing us. We want to get rid of that interest. We want to cancel out that interest as much and as quickly as possible. Because did you know that the banks don't make money off of your money? You know what they really make money off of? Time. They take advantage of time. They take advantage of time and balance. And it's time for us to do the same. Okay? So as we keep this in mind, time and balance, I want you to look this way. We've made the command decision to put this $10,000 to good use. And that is, we're going to deploy it towards the $88,000 principal. Now, of course, that's going to be, if we do it from the jump, $78,000. And we're going to see what happens when we do that. Now, remember, you have a cash flow of $500. So if you were to deploy this $10,000, you would then have a $10K balance. Okay, remember how you make sure you are getting rid or filling up, replenishing this $10K. How long is it going to take you if you only have a $500 cash flow? How long is it going to take you? 20 months. That's right. But you see, you said you didn't want to deploy that. And that's okay. You don't have to deploy it. Because as you're using your line of credit as your new checking account, guess what you're doing? You are still allocating your finances in the best way possible, which is the velocity banking way. Remember, you're using your line of credit as your new checking account. That means your income is coming in, let's say $5,000, and then your outgo is coming out, right, of that line of credit. So let's say 5,000 is the income, 3,000 is the expenses, 2,000, right, is the cash flow usually. But guess what? You're spending way more than that. So now we're going to be looking at just the $500 in cash flow. All right. So whatever your expenses are, right, is going to equal the cash flow of $500. Okay. And that's okay. That's all right. Listen, you're making 5,000. You're spending 4,500. You still got a cash flow of $500, which is going to be paying this line of credit back in 20 months. You say, well, CJ, I don't think that's going to make a dent. Yeah, yes, it will. Let me show you. Okay, let's go ahead and take this time to see what happens when you are taking advantage of the line of credit, knowing that you only have the $500 in cash flow. Let's compare, right, the traditional banking method to the cash flow banking method with that $10,000, okay? So let's make sure that we're on screen here, all right? And 733, right, is going to be the interest part. You know what? Let me go ahead and clean this part up. So this is with, I want you to keep in mind, this is with $10,000 deployed every 20 months. And remember, we're not doing this every 6 months. Remember, on the other videos, we do it every 6 months, right? Every 5 months, maybe even 7 months. This is 20 months that we're deploying the $10,000, okay? With only $500 as cash flow because we're using our line of credit much differently than regular people would do it, okay? We're doing it the velocity banking way. And I want to share with you what happens when we do that, okay? The $10,000 that has been deployed to the principal, look at what it does to the interest. So after about 11 months, okay, what do we see in the velocity banking and the traditional banking way of doing things? What's that difference? $91. That's $91 in your pocket, not theirs, all right? Then after 24 months, which one would you rather have? Would you rather owe the bank $455 or $643? Now, $455 is less than $643. Let's go all the way to month 48, and this is the most exciting part, at least to me. Month 48, that's 4 years, you're actually paying the bank $208. On the principal side, it's $954. That means that you're paying way more to interest than you would over here. About $320 more towards interest. Why? Because you know how to pay now. You know that the most important thing is not the interest rate, but time and balance. And not only that, but you know what a line of credit can do for you when deployed correctly. Now, if you only owe the bank, you went from $733 in the first month all the way to $208 in 48 months. Where are you going to be 6 months from now? From right here. Where are you going to be in another year? You see, folks, that's what we need. We need you to think for yourself because there's not going to be another chance to make this up. All right? Now, this is what numbers will do for you. When you know how to actually allocate your finances the correct way, okay? It's not that you've been doing it wrong. It's just that you didn't know that there was a better way of doing it. But now you know. So let me go ahead and get out of the way, right? Yes, to answer your question, you're going to be out of this loan in about 5 years and 10 months. So I would say I'm rounded all the way up to 6 years. That's better than 10 years, okay? Listen, and plus at the end of that 6 years, this $1,162 each and every month is going where? To you instead of to them. Do you have another car payment? Do you have another loan you can place this cash flow towards so you can pay it off even quicker? Yes. Do you have no loans? Well, now you need to get into good debt, which is a whole other video. All right. We want you to make sure that you are paying off these loans very quickly and in a way that you could still feel comfortable, that you don't have to be on the red beans and rice diet. All right. God bless you. We will see you in another video. Until then, continue Velocity Banking.